Let's discuss about the disclosure requirements under IAS 16 in respect of property, plant, and equipment. Before moving towards the disclosure requirements, I just want to point out a really important thing. Why do we need disclosures? Why there is a need of footnote itself? The main reason is that we are not able to explain everything to the users of the financial statement in the balance sheet, profit or loss. That's why we have notes. In notes, we provide qualitative or quantitative explanation about the various line items that we have included in the financial statements. So when you go through any annual report or any 10K or any financial statements, you just need to go through the notes. When you go through the notes, you will find a lot of information. These are the information which are required by IFRS. Required by IFRS, which means in order to understand the line item in a better way or explain the assumptions taken by the management in arriving at those figures, it is very, very essential to go through the notes and the disclosures. So at the end of every audit or at the end of every preparation of financial statement, we do a gap checklist run. In that checklist, we need to look into the requirements given under IFRS and we match it out with the financial statement based on the understanding, and we check that whether all the sections that is there in the IFRS and which warrant a disclosure in the notes to the financial statement have provided by the management or not. Okay, so this is the base of disclosure requirements. Now let's move on to the different requirements under IAS 16 and IAS 8 in respect of property, plant, and equipment. We discussed about two, three elements like the change in the useful life of the asset, change in the residual value of the asset, or the change in the depreciation method. So all of these changes are governed by IAS 8. How to account for those changes are governed by IAS 8. So if the entity make any changes in the accounting estimate or the accounting policies, they need to provide a disclosures mentioned herein. The first is the nature of the change. We've changed from A to B. Why did you change? The amount of the change, the number of years that we have changed, and the fact about the effect in the future period if it is not disclosed in estimating, if it is impracticable. Sometimes it's very much difficult for us to estimate everything, and we just have to disclose the fact and why we are thinking that a proper estimation we won't be able to make. So these are basically the change in the accounting estimate. Change in the accounting estimates. For example, residual value, the useful life. And let's move on to item set number 2 that deals specifically with the property, plant, and equipment. The first thing you need to disclose or the entity need to disclose about the measurement basis used by the firm. For example, we discussed that initially the all the PP&E is measured at cost, but subsequently they have two options. They can either go for the cost method or they can go for the revaluation method. So they need to provide a disclosure on a class by class basis on what is the measurement basis that they have taken. Basically, if it is different across the classes, then the class by class disclosures will follow. The depreciation method used by the entity, because there are a lot of depreciation methods that are there available in the market. Which one the entity picked up that they require to disclose? The useful life of um, the useful life of the property, plant, and equipment, and the depreciation rates. Basically, I would say that the useful life is relevant in respect of straight line method of depreciation, because I would be depreciating the asset or the depreciable amount over the useful life of the asset. And for straight line method also there are depreciation rates, but the depreciation rates are more relevant in case the firm is following a written down value method. I need to know the rates that they are applying over the cost of the asset. Now, these are generally form part of the significant accounting policies. Significant accounting policies included within note number 2 or note number 1, as the case may be. Let's discuss about the numerical figure. These are basically qualitative disclosures. Let's deal with some level of numerics that generally required to be disclosed in the notes. The gross carrying amount, the gross carrying amount and the accumulated depreciation is required to be disclosed for the beginning of the period. For example, 1st January 2018, I have this much of PP&E at gross, this much of PP&E in respect of accumulated depreciation, and this much of PP&E balances in respect of accumulated impairment losses. Now the entity is required to disclose the additions, all the additions in the PP&E, whether by way of purchase, whether by way of mergers and acquisitions, they need to provide a disclosures. And I would say that all the additions, if they are different in categories or different way of acquisitions, the proper bifurcation should be provided. That's an important point for the entity who are preparing financial statements. Separate disclosure is required for assets that are held for sale because these are not covered by IAS 16. Hence, even if they are not covered by IAS 16, they form part of the PP&E schedule. And hence, they need to separately mention that these are the PP&E that are held for sale within IFRS 5. Here I mentioned earlier that acquisition in respect of business combinations, because we don't do business combinations every day, and this is a special nature of transaction, and hence I'm assuming that the entity should provide these disclosures. Increase or decrease as a result of revaluation or the impairment losses during the current year that are recognized in the OCI. So any revaluation you have made and any impairment losses that the entity has incurred or reversals, basically all of these things should form part of the notes to the financial statement. The impairment losses that are recognized during the current year, the amount of impairment losses, the amount of impairment losses that are reversed during the period, and the amount of depreciation that is recognized during the current period. So these are series 1 disclosure that are required to be provided in the notes to the financial statements.